Hello, everyone. Welcome to Smart Investing. I'm Albert, host of the channel, like always. So, today's video is going to be about the banking sector. Uh, I have I don't know how many stocks I have left, but I have maybe around 5 pages left. On each page, I have about I don't know, I'll say more or less around 40. So 40 times 5, 4, 8, 12, 16, 20. So about 200 stocks left for that sector, and I'll finally be done. So, in all reality, the amount of time that it took me to do that actually took about a year. So, we're talking about hundreds and hundreds of companies. So, I mean, this is pretty tough to analyze all these companies, especially with these ongoing changes year to year. So, anyhow, these are the 5 stocks that I have for you guys. I'm going to run right through them. I'm not going to do like 10 stocks as before. I'm going to do some minor improvements this year so I can give better value, quality, and information for you guys to understand. So, first stock up that I have is PVBC. Again, these are all banking stocks, hopefully. And if they're not banking stocks, I will show that. And then on top of that, they are definitely in the financial sector, or they are related to the banking sector, or they might be a lending institution of some sort. But on the application, it just happens to be that uh, it's it's sort of like a bank, but not quite. Because the only difference is banks are usually national. They're more than one state instead of just a surrounding city or a certain area or a community. So it's not as private, it's just more public to more people and more access to people. So obviously they're going to be making more money. And lending institutions, depending how small and how big, uh, but usually they're a little bit smaller when it comes to lending institutions. So anyhow, just thought you guys might want to know that before I start the video. I know I've mentioned that before, but it's always good to refresh that information. So first things first, ticker symbol PVBC. Name is Provident Bank Corp Inc. at $9.02. Really cheap for a stock. Again, me personally, I do not like the banking sector. A lot of these banks are just overvalued and pumped with a lot of debt. It's just not what I like. I like to find everything pretty much good. I want the market cap to be somewhat of a small company in the billions. I like high quality, good value. The price, I don't mind if it's expensive, but it has to have quality and some growth and some really good value. It has to just hit every major point. But anyhow, for this stock, $159 million market cap, 52-week high and low of a difference of $11. Earnings you see here are negative. That's definitely bad. This just made the mark for the $10 difference. Market cap is pretty awful. PE ratio, it's not telling me anything, so definitely questionable. Forward PE is at 5. Just with the price alone, I know people like cheap stocks, but for a bank, this is definitely way too cheap. And obviously, the cheaper they are, yes, they have more growth, but it just depends on the company if they're good or not. And then on top of that, even if they're good, it has to be attractive to investors and people who would want to invest big all the way to small. So really that plays a major role as well. That's pretty much one of the standards. So anyhow, dividend it pays 16 cents. We're only looking at 4 cents each quarter. Sorry. Let me make sure. 4, 8, 12, 16, 4 quarter. Okay, yeah, so 4 cents each quarter. I don't like this stock. Just by looking at this first page, these are awful numbers. Just by looking at them. But again, we can continue, and I could still be wrong when we deep dive into the fundamentals. So for the 1-year chart, let's look at the 5-year. As we can see here, let me go back. Okay, click on the 5-year. Real big dips. So in 2020, it took a dip, started to go up in 2021. Then it took a major downturn again. So really with this big dip, it seemed pretty flat. Not a lot of spikes, but again, you can see that slow downtrend going down. Then these really big dips. This is not a buy the dip and sell the rip. Slowly going up. Again, there's not a lot of, well, it has some volume, but this is not a stock, me personally, I would like to jump into. So yes, the last 3 months, it's gone up, but again, not bad for a $2 move, but again, you're going to see these kind of charts ever since October, going straight up, especially 2023 starting to go up. So again, I caution the beginning of the year because we ended at a sour year, and then to jump into the new year and everything wants to seem like it's back to normal, and it's not. So we have these strange upticks and these strange uptrends, I would say. And so it's just really strange to see that, even for the banking sector. So it's going up, obviously, for the 1 month. It looks like it's on an uptrend. The 3 months, I don't have the proper charting information because sometimes I do like to share it, sometimes I don't. So just by looking at it, seems like it's at a slow uptrend. But me personally, again, it's not a stock that I would like to look at or get involved with. Now, for the quant rating we have here, it said it's good for growth. It's very cheap. Quality, I don't know about that. Overall rating, it's giving it a 4.0 rating out of 5. Growth, I don't, just because it's cheap doesn't mean the price will go up again. It just means that, well, sorry, for the value. And then for growth, it would have to have some advantage. So let's read about the company real quick, and we'll see what's going on with that. So with this company, it says, look at these earnings. They're pretty flat. Then we have the margins. It's not showing me anything. I apologize for that info. At least I'm getting some 2022 information, which is really good. So negative income. That is awful. Awful. So that alone, stay away from this stock, just like I said. Even if they have positive cash flow, they have lost a lot for 2022. And again, they didn't give me any 2022 information for the cash flow. But going negative for 2022, that's awful. Dividend, I don't even want to look at. It's horrible, really. 4 cents per quarter. And we'll read a little bit about it and then move on to the next one. So this company's in Maryland. Typical bank doing checkings and savings. And what are the locations they are in? It says Massachusetts, Southeast New Hampshire. So basically in the northeast section. Yeah, that's pretty much it. So for this bank, I'm going to say no to the watch list. And we will jump into the next one. Next one up is PFBC, Preferred Bank of Los Angeles. So we're going to look at the first page. $1 billion market cap. Okay, that's not too bad. 52-week high and low of 62, high of 81. Almost a $20 difference. So that checks out. It's not too bad. PE ratio is at 8. We have dividend at 2.2. Dividend yield at 3. Earnings per share at 8.72. That's pretty good for earnings per share, especially for a market cap of that size. Then we have here the 5-year. So out of the 5-year, the last 2 years before the downturn in 2020, obviously, it was around 58. We can say, and you can see here, ever since 2021, it has stayed above the $57 mark. So definitely has some momentum aside from these spikes. It's hard to gain a top and a bottom. So back in August, it looks like they reached a high of 74, dipped down back to 65. That's a $10 difference. $10 downtrend. Then it ticked up again to break the new highs. I wouldn't say break new highs for the year, but for the past 3 months. And it only broke it by, I'd say, a few bucks, $3. So now it actually looks like we're in that downtrend once again. So it's not really reaching new highs. I don't know if you guys see that. It's like trending down. So now, even if it does trend down, I would like to see it go into this kind of level. So we're talking about a level of the mid 60s. Let's be fair and say 64. And then let's go to the 3-month. So with this downtrend here, it's gonna keep like going lower, lower, and lower, 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 lower. And then I want to try to aim it down to like 64. And then from there, that's when it might get a breakout. And then we'll see for sure if it goes up or down. So even if you were into this stock and were interested for some reason, for some odd reason, I'd say wait for that breakout and wait. I'm pretty much waiting for the confirmation. And then we're going to dig into more of the fundamentals. But before that, we're going to look at some quants. Since it's a high quality stock, not really sure about that. That was the highest rating. Then we have momentum and growth. Income, that's out the window. I've seen better income than that. Value, I can't really say since it's not really an interesting stock anyway. So what that leaves is quality, growth, and momentum. As for quality, overall, sector by sector, again, I don't like the banking sector. That's how I would rate it. So again, just for sectors alone, I don't like the banking sector. But when it comes to the stock alone, they probably may be doing something right. We'll look at the dividends real quick. So they do have rising dividends. That is a good sign. They do have splits. So last split was in 2011. Hopefully that doesn't happen. Even with the next 5 to 10 years. Now we're going to look at financials. Earnings have been estimated to go up, which is good. Nothing wrong with that. And then for 2023, who knows? But for the Q1, comparing to Q4, they look about flat. So I'm surprised to see this stock have estimates going up. So who knows? They may be doing something very, very good during that time for 2022. Now, I want to see if I have annual estimates. So I do have annual numbers. 2% return on assets. That's really low, but considering the banking sector, seems okay. ROE, we have there. Um, that was actually the best year out of the last 5 years. And then their earnings, I would say, if these two are going up even slightly, the ROA went up slightly, but the ROE went up even more. So I would assume the earnings, again, like I thought, would be better than the last 5 years as well. It almost looks like they were prepared to have a bad year or expecting a bad year for things to get worse. But who knows? Again, we started just 2023, and we still, I'd say, one more month just to end this first quarter. So we still have some time to go. We still have halfway to go till reporting for the next quarter. So we have here, I would say, better margins as well if the net income would be better just based off the equity and assets. Debt is around the same. Net income, like I thought, would be really, really good. So this company is actually doing okay. It's not something I would add to the watch list, but I do have to give this company credit that they have been doing pretty good, actually. They have been doing pretty good. So with time going on, hopefully this stock can still do pretty good throughout time. And I would like to see the market cap grow a little bit better. And hopefully the dividends grow as well. But what I have to say, even though they had a good, pretty good 2022, I think there's the worst is yet to come. I don't know if this company is prepared for that, but we'll see. The company seems to be doing pretty good, actually, looking at the numbers, even aside from the charting going up and down. To me, it's just staying in that range, which ain't bad, so it is holding up. And then for the company, I want to see what they do. So they're an independent commercial bank, primarily in California. And then they work on real estate finance, commercial loans, small and medium-sized businesses, entrepreneurs, real estate. So they work with a variety of people. So that's actually pretty good. They're pretty diversified as to how they do businesses and transactions and how to grow their business, which is really good just by reading it. And I really don't see this too common with banks. I've seen it, but for them to mention that and say they work with these kinds of people, that's pretty admirable. So I would give them credit, and then they also have good locations. If you can see, it says they're in California, but I'm trying to think where. And then it says the main office is in LA, but then it also says they have 11 branches. I just want to see what other branches they have. Aside, because I don't know these counties. I wasn't born in Cali. I've only visited Cali once, so I have no clue what demographics are there, or what kind of citizens are there, or I have no clue. I don't know if it's a rich neighborhood, poor neighborhood. I mean, you might live in a decent neighborhood, but you might visit elsewhere to do banking. So anything goes, really. I'm familiar with New York, especially the city. A branch in Flushing, New York. That's It's like a middle class neighborhood in Flushing, New York. That's all the way the last stop, actually, on the 7 train, if I remember correctly. So, that area, primarily Asian, definitely Chinese, uh, working class neighborhood. So, I wouldn't say really high income neighborhoods in that area, but they just might do other kinds of businesses. Maybe some real estate, I would assume. Uh, and I'm not familiar with Houston. I've heard of it, but what I'm saying is I haven't visited, or I don't know the ins and outs of that city. So when I actually do my research, like I know and I've been there and I've lived it pretty much. But I haven't lived anywhere else really in New York and Florida. So I don't know. So says basically activities come from mainstream market of Southern and North Cali. So it looks like they're trying to expand basically all of California, which I give them credit again, based on picking good locations to do businesses and to expand the market. Even though it's really insane, I guess, to do banking in major cities. So I'll give that to them. Even though I say no to the watch list, uh, I'll give them actually uh, not even a yes or no, just to hold off on it, see how they do later on. But I would expect good things from this company. It's almost like talking to a student, and I'm the teacher saying, "Oh, is this student going to be good or bad in the future?" Seeing how they do, how they run this company, and I see a lot of potential. I can say that. I see a lot of potential for this company. So next stock up is EBC. EBC, uh we have Eastern Bank shares. I looked at the price and it's just awful. And then I saw the chart, that downtrend. It's awful. See here, it broke that floor and it broke that level. And here I see here, and then you can clearly see um, really big drop there. And then it tried to come up, waiting for confirmation. Another big drop. So that's further confirmation right there. And definitely the technicals do not support it. Not as of this year. So definitely stay away from this. And hopefully we can find other stocks. So technicals don't support it. I'm going to look at this first page now. 13 PE. 52-week high and low. So not even a $10 difference. Market cap is okay. Earnings are pretty low, especially for that size of a market cap. Dividends are only 40 cents. Dividend yield is pretty low. Awful numbers, really. Volume seems okay. Seems pretty active. Really active, actually. And I should actually be focusing more on different factors, how to evaluate this, like PB and price to sales. But I haven't fully. I learn it, and then for some reason I always mix them up, and I have to just learn one more instead of learning all three, and it throws me off. And I think I guess I'm so focused on other things and other ideas and other things that I want to do that it just kind of phases out, and it becomes inaccurate for me to evaluate it based on other measures when I should know this. But I apologize. I will grasp it as time goes on. But with the numbers, I don't see it supporting fundamentals nor technicals. And so for the quants, you can see here that The highest rating is growth at an 8.8. This also earned a 4 out of 5 rating. I don't see how. Earnings are expected to be slightly higher, then flatten out for Q4 and Q1. Sorry, Q4 for 2022. They missed, and then for Q1, they're expected to report in April after the market closes. So Q1 and Q2 they beat expectations, and then Q3 and Q4 they missed. And I guess the stock punished them. So whether that hits or misses, the stock is down too much. So I wouldn't even go for it. Just even if it did have good numbers on net income and fundamentals, just people just didn't like the stock. So remain flat for ROE slightly higher, earnings just slightly better than the last 5 years. Debt about the same from last year, and comparing to the last 5 years, about the same. Not much. Net income has gone up. It's pretty good, but people are not supporting it. Don't have info for revenue, operating income. Just reviewing top and bottom line. So 90% debt, 89 to be exact. Too much debt in my opinion, and for too long. You see all those numbers there, pretty consistent with debt. Doesn't look like they want to pay it off and just do whatever, or maintain their assets with their debt and keep it at that same level. That just doesn't work for me. It might work for somebody else, but cash flow we're going over. So we have here negative cash flow. Yeah, definitely negative cash flow, and there you have it. Even for the dividends, not much of a raise from 8 cents to 10 cents. Awful raise. Let's read a little bit about it. So they have subsidiary. So it's almost saying like they're a division of a corporate company. And Eastern Insurance Group LLC, banking, trust, and investment and insurance services. Sorry, I couldn't underline it properly. Include lending, deposit, wealth management, insurance products. The more they do, the better. Or maybe it's just not in the description. Sorry, I messed up on my underlines. But it looks like they do a lot, but the stock is not being supported by investors. So I'm going to say no to this stock as well. So next one up, OPBK, Op Bancorp. You can see right away that the stock, it actually went in a downtrend. Then it went up, then it went flat pretty much on that consolidation phase. So liquidity, not much. PE ratio 5.2, 6.9 for the future. Dividends at 48 cents. Dividend yield at 4, 2.2 for earnings. Not even a $10 difference. It's not worth it for the value for that price. Market cap really low. I'm not fond of it. Again, just bad numbers overall. Bad numbers overall. And then analysis here, we have some quality, but for another one with a 4 out of 5 rating. Highest value is 8.5, so it's only giving you a good price, pretty much. Rising earnings estimates, and then for Q1 2023, very, very, very low expectations. By the numbers, it doesn't seem like a big drop, but just by the difference, that is a big drop. And then we'll see what happens. But for this stock, it doesn't seem like people like it. Investors don't seem like they like it. ROA, ROE. We have ROE did pretty good, and the ROA did okay. Margins, it's not showing me. The debt, about the same. Net income actually did pretty good for 2021, but it's not giving me 2022 numbers. I would actually like to see if this was about the same or more. If not, then I'd actually be surprised, and then that'll actually have me thinking about trends. If smaller banks are doing better for 2022, then what does that say? That would say people are putting money into their banks. Investors are putting money into the selective banking stocks. If you want to be more accurate about it. So with that said, this stock is awful. Needs some work. Again, I don't have 2022 numbers, but 2021 seemed okay. But the estimates worry me, and they missed out big on the last one. Obviously, the debt is very, very concerning, especially for that duration of time, year to year. Very, very concerning. That's typical on banks, which is why I don't like banks. And then we'll read a little bit about it and jump into the next one. So definitely no for this stock. For the watch list, definite no. I guess typically they do what any regular bank does. For some reason, their customer focus is on the Korean American community. Okay, that's not a wide variety of a group. I get you're trying to expand a certain community, but you could only go so far with that. So in order to expand businesses, you can't just focus business on a certain ethnicity. I can understand an Asian market, that makes more sense, but if you want to be more specific on a diverse group or ethnicity or certain background, then it's just going to limit your potential. So that's all I can say. More power to them, but if they're going to stick like that in the long run, it's just not even worth it to believe in the growth of the company if they just want to stick to being limited. So last stock that I have, Bank of America. Obviously, these are one of the biggest major banks. They have been in a downtrend, so they're still holding up almost in the 2020 highs. As we can see here, they're just bouncing around there by the 2020 highs. Now, that's no surprise. That is no surprise. Again, I would like to see this go lower. And obviously, as one of the biggest banks in the world, $285 billion market cap. This one is definitely going to be an exciting one to evaluate. So 52-week high and low, that would meet expectations. Market cap is pretty good. Volume is insanely liquid. PE ratio is at 11. Forward PE is at 10. Dividend kind of sucks. It's pretty bad, 88 cents. Earnings per share, it's pretty awful to see that from a top 7 bank, 3.18. That's a pretty bad number. I would have expected it a little bit more. I can understand they can't grow more because they're so big unless they buy out other companies or upgrade technology or something in order to uh, innovate, is what I'd like to say. So other than that, uh, yeah, I'm going. I'll feed you soon, okay? So with the numbers, they seem okay, but it's understandable. I get it. Just because they're such a big bank, it reminds me of J.P. Morgan Chase when I reviewed it. It's like the numbers were really good, but then how are they gonna grow? And I'm sure they'll think of ways because they have so much potential behind their earnings, and they're just so dominant with that. It's just they're a big fish for this space. Now, for the past year, again, I've been saying they're pretty flat. If you're interested in this stock, I'd wait for further confirmation. I'd like to see a dip uh, below that 2020 high and have it stay there resting at least for a few months, and that would be maybe a nice time to jump in. I wouldn't stay for the long term, as you can see for this stock in 2022, it was highly volatile. I can't say if 2023 is going to be a highly volatile year. We just have to go off of month to month. Just go with the flow pretty much and see what happens. I'm not making any predictions. It would nice. It would be nice to see, um, obvious trends, but that's just not the way the stock market works. You just have to do things in increments. So with that said, you just have that small range there. You can't be so greedy. So for the technicals, uh, they're okay, but again, they need some work. And the fundamentals seem okay. Now for this stock, the highest rating for the quant was value. So you're getting a really good price, is telling me. Well, fairly above average price for this stock. I just don't see the earnings supporting it. I would really like to see the earnings potential on this. So looks like they hit, and they hit the last 3 out of 4. And then for Q1 2023, it's been upgraded closer to its last estimate. And if they beat that, which I'm sure they expected to, we'll see what happens. But again, I get why banks aren't liked as of right now. High interest rates, it's hard to borrow money, but they see it as an opportunity regardless of that, because they have high interest rates. So I have some 2022 numbers. So these numbers, they're about the same, nothing crazy. They just look very, very stable. Doesn't look. I don't see anything that stands out to me. Everything seems pretty normal. Doesn't seem like they're like doing anything special. As we can see, an extreme amount of cash flow here. They have negative cash flow, but them being the biggest bank, I'm sure they'll find a way. So 27 billion, I'm going to add that to the cash flow and see if that makes any sense. So 320. So wow. This is what they're doing. And it almost breaks even. They have negative cash flow, but what they gain from their net income, their bottom line, it looks like they use every single dollar for net income as cash flow. And I don't know the exact numbers, but just by guesstimating, it looks like they broke even. So pretty much they're down to zero. They have like nothing to spend. They're not like positive or negative. They're just like very, very tight on money. And uh, they would actually have to grow their revenue somewhat. So if they're borderline breaking even, it's not a bad thing or a good thing, I guess. It would really come down to the stock price. So for them to gain market share, uh, they would have to break out of this volatility range and actually gain more capital, more than this past year, and exceed expectations really. And investors would have to be on their side for the upside in order for them to gain market share. So really, they're just hanging by a thread from what I'm looking at, what I'm analyzing. I want to see. I don't really care about the dividends; they're pretty low. So we have 18 cents in 2020, going to 21 cents in 2021. And then in 2022, they paid 22 cents. So that's easy to remember. In 2022, they paid 22 cents. You know, it just matches the year. And then last but not least, we're going to read a little bit about it. And this will end the video. So it looks like there's segments: global wealth, investment management. Obviously, they're going to work with high net worth individuals. Not going to say, but I would assume. So it says they're focused on clients with over 250,000 in total investable assets, including solutions to meet clients' needs. So I get that they want to. That makes more sense. Instead of working with high net worth individuals, which is considered $1 million or more, they actually cut that back to 250,000. So it looks like they're trying to work with people more. So I guess that's actually a really good sign. It's not insanely rich, but I guess in this day of age, for some people, it's doable. $250,000. I would assume people are retired, would have that kind of money, so it is doable. And I guess they want to work with lower income people, which makes more sense. So I guess they want to. I wouldn't say screw everyone up because interest rates are high, but I guess they want to diversify their pool of businesses. So again, Bank of America seems okay. Would I add this to watch list? I would say no. It needs some work on it since they're breaking even. So I would say no. Again, I like other sectors that are related to the banking sector. But again, people like banks, so be it. So that's pretty much it. That's all I have for you guys for this video. I hope you guys enjoyed it. And I'll see you guys in the next one.